The architecture that has quietly underpinned global energy trade and dollar demand for half a century is under visible strain. Recent shifts in energy settlement practices, reserve management, and geopolitical alignment are forcing U.S. policymakers to confront a risk long treated as theoretical: the erosion of the petrodollar framework. This matters now because energy markets sit at the intersection of trade, finance, and geopolitics. Any disruption to dollar-based energy settlement reverberates through currency markets, treasury demand, and global liquidity conditions. The response unfolding is not about preserving dominance for its own sake, but about preventing disorder in a system where energy pricing anchors capital flows and balance sheets worldwide. The urgency reflects an understanding that once confidence in settlement norms weakens, rebuilding it becomes exponentially harder, with consequences that extend far beyond oil markets. For decades, the dominance of the U.S. dollar in global energy settlement was not the result of a single treaty or explicit mandate, but the cumulative outcome of convenience, trust, liquidity depth, and geopolitical alignment. Oil and gas contracts priced and settled in dollars created a self-reinforcing loop in which energy trade generated predictable dollar demand. That demand flowed through global banking systems, and surplus revenues were recycled into dollar-denominated assets. This system lowered transaction costs, reduced currency risk for counterparties, and anchored global trade finance to a single, highly liquid unit of account. What is now unfolding is not a sudden rupture of this framework, but a gradual and deliberate diversification that reflects changing risk calculations rather than ideological rejection. The shift is incremental, but its implications are structural, because energy settlement sits at the core of how dollars circulate globally outside U.S. borders. The drivers of this diversification are practical and increasingly difficult for market participants to ignore. Sanctions policy has transformed currency choice from a neutral operational decision into a strategic vulnerability assessment. Energy producers and consumers alike have observed that settlement currency can determine exposure to asset freezes, payment delays, and secondary sanctions risk. Even actors with no immediate sanctions exposure are adjusting behavior based on precedent rather than probability. The lesson absorbed across energy markets is that dependence on a single settlement currency concentrates political and financial risk, regardless of its liquidity advantages. As a result, counterparties are exploring alternative arrangements not to replace the dollar outright, but to introduce optionality that can be activated if conditions deteriorate. Bilateral trade imbalances further reinforce this trend. Large energy importers with persistent current account deficits in dollars face growing pressure to manage external balances more actively. Settling a portion of energy imports in local currencies or third-country currencies can reduce the need to source dollars in stressed funding environments. For exporters, accepting non-dollar settlement can facilitate access to key consumer markets and support broader trade objectives. These arrangements are often embedded within wider economic cooperation agreements, currency swap lines, or investment frameworks, making them more resilient than isolated pilot transactions. Each individual deal may be small relative to total global energy trade, but collectively they signal a willingness to operate outside the default dollar-centric model when incentives align. Strategic hedging also plays a central role. Energy revenues are volatile, and producers increasingly manage their balance sheets with a portfolio mindset rather than a purely transactional one. Holding reserves and receivables in multiple currencies can reduce exposure to dollar interest rate volatility, U.S. fiscal dynamics, and shifts in Federal Reserve policy. In an environment where U.S. yields are elevated and issuance is expanding, the opportunity cost of concentrating reserves in long-duration dollar assets has increased. Diversifying settlement currencies allows producers to align revenue streams more closely with expenditure needs, investment plans, and regional trade patterns. This is a financial optimization process, not a political statement, but it nonetheless alters aggregate dollar demand over time. The signal effect of these changes is as important as their immediate quantitative impact. Dollar-based energy settlement once conveyed a sense of inevitability, reinforcing the perception that the dollar was not merely dominant but indispensable. As alternative settlement arrangements become normalized, even at the margin, that perception shifts. Market participants begin to view currency choice as a variable rather than a constant. This subtle change in expectations affects TS behavior well beyond energy markets. Banks reassess their dollar liquidity buffers, corporates adjust hedging strategies, and central banks revisit reserve composition assumptions. The dollar remains central, but it is no longer treated as the only viable conduit for large-scale commodity trade. This evolution reduces the automaticity of dollar demand generated by energy flows. Historically, oil and gas trade ensured a steady baseline of dollar transactions regardless of broader market conditions. Even during periods of stress, energy trade continued, sustaining dollar circulation and supporting offshore dollar liquidity. As settlement becomes more diversified, that baseline becomes less rigid. Dollar demand tied to energy flows becomes more elastic, responding to relative funding costs, political considerations, and bilateral arrangements. This does not eliminate dollar usage, but it weakens one of the structural anchors that previously stabilized demand during periods of volatility. The implications for global dollar circulation are cumulative rather than immediate. No single agreement or transaction materially alters the dollar's role, but the aggregation of small shifts changes the distribution of flows. Over time, a smaller share of global trade-generated dollars returns automatically to U.S. financial markets. This affects the recycling mechanism that has historically supported demand for Treasuries and other dollar assets. While the impact may be masked during periods of strong private capital inflows or elevated risk appetite, it becomes more visible when markets are stressed and marginal buyers matter most. In such conditions, the absence of passive, trade-driven dollar demand amplifies price sensitivity and volatility. U.S. policymakers are acutely aware of these dynamics and are responding through a combination of diplomatic engagement, financial incentives, and strategic reassurance. Engagement with key energy producers increasingly emphasizes the benefits of dollar settlement in terms of market access, financial infrastructure, and risk management support. Swap lines, regulatory cooperation, and investment facilitation are used to reinforce the practical advantages of remaining within the dollar ecosystem. These efforts reflect an understanding that settlement norms persist because they are convenient and trusted, not because they are imposed. The objective is to maintain the dollar as the path of least resistance rather than attempting to prevent diversification outright. However, the effectiveness of this response is constrained by the broader geopolitical environment. Strategic competition and fragmented alliances limit the credibility of assurances that were once taken for granted. Energy producers with diversified political relationships are less willing to accept concentrated financial exposure, regardless of incentives. At the same time, domestic political considerations in the United States restrict the scope for concessions that might otherwise reinforce alignment. This creates a delicate balancing act in which policymakers must preserve confidence without appearing to weaponize dependence, as such perceptions would accelerate the very diversification they seek to manage. The gradual diversification of energy settlement currencies also interacts with broader trends in global finance. As capital becomes more selective and liquidity conditions tighten, the marginal utility of dollar settlement declines for some participants. Alternative currencies backed by regional trade networks, swap arrangements, or commodity-linked frameworks become more attractive at the edges. This does not constitute a parallel system capable of replacing the dollar, but it does create multiple partial pathways that reduce systemic reliance on a single channel. The result is a more fragmented settlement landscape, with implications for transparency, liquidity, and risk transmission. From a stability perspective, the concern is not loss of dominance but loss of uniformity. A single dominant settlement currency simplifies risk management and crisis response. Fragmentation complicates both. Multiple settlement currencies increase the complexity of hedging, raise operational costs, and introduce new points of stress when volatility rises. During periods of market disruption, liquidity may not be evenly distributed across currencies, leading to bottlenecks and abrupt repricing. The dollar's role as a universal intermediary once mitigated these risks by concentrating liquidity. As that role becomes less exclusive, the system's shock-absorbing capacity diminishes. It is important to emphasize that the dollar remains deeply embedded in energy markets and global finance. Its liquidity, legal infrastructure, and market depth are unmatched. The diversification underway does not reflect a wholesale rejection of these attributes, but a recalibration of exposure in response to a changing risk environment. The danger lies in misinterpreting gradual change as inconsequential. Structural shifts often appear benign until cumulative effects reach a threshold where behavior changes more rapidly. By the time such inflection points are evident, policy options are narrower and more costly. The current phase should therefore be understood as an early-stage adjustment rather than an end state. Energy settlement practices are evolving in parallel with geopolitical realignment, monetary tightening, and fiscal strain. Each factor reinforces the others, altering incentives at the margin. The dollar's central role persists, but its exclusivity is eroding, and with it the automatic stabilizing function that energy trade once provided. Managing this transition without triggering disorder requires careful calibration, credible engagement, and an acceptance that confidence is maintained through reliability rather than compulsion. The stakes are high because energy trade is not merely another market segment. It is a foundational pillar of global economic integration. As settlement norms evolve, they reshape the flows, expectations, and vulnerabilities of the entire financial system in ways that are only beginning to be fully priced in. For much of the post-Bretton Woods era, the recycling of energy revenues into U.S. financial markets functioned as a quiet stabilizer of the global system. The mechanism was not formalized in any single agreement, but it was deeply embedded in the operating logic of international finance. Oil and gas transactions settled in dollars generated large, persistent dollar surpluses for exporting states. Those surpluses, managed by central banks, sovereign wealth funds, and state-linked financial institutions, were reinvested predominantly into dollar-denominated assets, with U.S. Treasuries at the core. This flow helped anchor demand for U.S. government debt, compress term premia, and ensured that rising U.S. deficits could be financed at relatively low cost. The system worked not because participants were indifferent to risk, but because the combination of liquidity, safety, and political alignment made dollar assets the most efficient repository for surplus capital. What is now unfolding is a gradual weakening of this automatic recycling process, and its implications for U.S. financial markets are becoming increasingly material. Reduced petrodollar recycling does not mean that energy exporters are exiting U.S. markets en masse. Rather, it reflects a shift from mechanical reinvestment toward more discretionary and diversified portfolio management. In earlier decades, the scale of energy revenues and the limited range of credible alternatives meant that a substantial share of inflows found their way into treasuries almost by default. Today, exporters face a different landscape. Fiscal needs at home are larger, domestic investment agendas are more ambitious, and geopolitical risk considerations weigh more heavily on asset allocation decisions. As a result, a smaller portion of each marginal dollar earned from energy trade is automatically funneled back into U.S. government securities. This change may appear incremental on an annual basis, but its cumulative effect is significant when placed against the backdrop of expanding U.S. borrowing requirements. The timing of this shift is particularly sensitive. U.S. Treasury markets are operating under conditions of historic issuance driven by large structural deficits, rising interest costs, and frequent refinancing needs. The supply of duration that markets must absorb is elevated, while the capacity of traditional buyers is constrained. Domestic banks face balance sheet limitations and regulatory costs. The Federal Reserve is no longer expanding its holdings and remains focused on containing inflation. Pension funds and insurance companies, while still important buyers, are selective and sensitive to valuation. In this environment, the marginal buyer matters more than ever. When a traditionally reliable source of price-insensitive foreign demand becomes less predictable, the burden of absorption shifts to investors who require higher compensation for risk. This dynamic manifests most clearly in term premia. As automatic recycling weakens, investors demand a higher return for holding long-dated treasuries to compensate for supply risk, liquidity risk, and uncertainty around future policy responses. Rising term premia do not signal concerns about default, but they do reflect a reassessment of the balance between supply and demand in the world's most important bond market. Auction outcomes have become more closely scrutinized, with tails, bid-to-cover ratios, and dealer takedowns treated as signals of broader market stress. Volatility around issuance events has increased, reinforcing a feedback loop in which higher yields raise financing costs, which in turn contribute to larger deficits and further issuance. The reduction in petrodollar recycling also affects global liquidity conditions. When energy revenues are recycled into treasuries, they support the collateral base of the global financial system. Treasuries are not merely a funding instrument for the U.S. government. They are the backbone of repo markets, derivatives margining, and cross-border liquidity management. A steady inflow of foreign demand helps maintain market depth and smooth price discovery. As that inflow becomes less automatic, liquidity conditions can deteriorate more quickly under stress. Small imbalances between supply and demand translate into larger price moves, and dealers become less willing to intermediate during periods of volatility. This increases the likelihood that shocks propagate through funding markets rather than being absorbed quietly. From a policy perspective, this development narrows the margin for error. In previous cycles, the combination of strong foreign demand and accommodative monetary policy provided a buffer that allowed the U.S. to respond aggressively to downturns without immediately destabilizing funding markets. Today, policymakers operate with fewer degrees of freedom. Elevated deficits limit fiscal flexibility, while persistent inflation concerns constrain monetary easing. The diminished automatic recycling of energy revenues means that any increase in issuance must be more carefully calibrated to market capacity. Misjudgments are more costly, as they are less likely to be offset by passive foreign inflows. The domestic consequences extend beyond government borrowing costs. Higher Treasury yields feed directly into broader financial conditions. Mortgage rates, corporate borrowing costs, and equity valuations are all priced off the risk-free curve. As yields rise to attract marginal buyers, financial conditions tighten across the economy. This dampens investment, slows credit growth, and increases the sensitivity of asset prices to negative news. The transmission is not linear, but it is persistent. Even if yields stabilize at higher levels, the adjustment process itself can generate volatility that weighs on confidence and risk-taking. Internationally, the effects are amplified. Many global assets are priced relative to U.S. rates, and higher Treasury yields can trigger capital reallocation away from emerging and frontier markets. Countries reliant on external financing face higher borrowing costs and currency pressure as global investors rebalance towards safer, higher-yielding dollar assets. Ironically, this can increase short-term dollar demand even as structural recycling weakens, creating a more unstable pattern of flows. Instead of steady, predictable inflows linked to trade surpluses, markets experience episodic surges and retreats driven by risk sentiment. This volatility complicates policy planning for both issuers and investors. U.S. authorities are acutely aware of the importance of maintaining stable demand for treasuries, and the role that energy-linked flows have historically played in that stability. Diplomatic engagement with major energy exporters increasingly incorporates financial considerations alongside security and trade issues. Efforts to reinforce the attractiveness of U.S. markets include regulatory cooperation, investment facilitation, and assurances around market access. At the same time, there is recognition that reliance on external recycling carries its own vulnerabilities. A system dependent on the discretionary choices of foreign sovereigns is inherently exposed to geopolitical shifts. Preventing abrupt disruption is therefore a central objective. Gradual adjustment allows markets to reprice risk and reallocate capital without triggering disorder. Abrupt changes in recycling behavior, by contrast, could overwhelm market capacity and force destabilizing policy responses. This is particularly dangerous in an environment where confidence is already fragile and liquidity buffers are thinner. The challenge for policymakers is to manage the transition without undermining the credibility of the dollar or the depth of treasury markets. It is important to emphasize that reduced recycling does not equate to rejection. Energy exporters continue to hold substantial dollar assets, and treasuries remain a core component of global reserves. The issue is not the level, but the elasticity of demand. When recycling was more automatic, demand was relatively insensitive to yield movements or short-term policy noise. As it becomes more discretionary, demand responds more quickly to changes in valuation and risk perception. This increases volatility and reduces the stabilizing effect that foreign official flows once provided. Over time, this shift may encourage structural changes within U.S. markets. Greater reliance on domestic savings, adjustments to issuance profiles, and efforts to enhance market liquidity could partially offset reduced foreign recycling. However, such adjustments take time and require political consensus that is difficult to achieve. In the end, markets must navigate a period in which supply is high, demand is more selective, and policy flexibility is constrained. The erosion of automatic petrodollar recycling thus represents a subtle but important pressure point in the global financial system. It interacts with fiscal strain, monetary tightening, and geopolitical fragmentation in ways that amplify risk. Each factor alone might be manageable, but together they reduce the system's tolerance for error. U.S. financial markets remain deep and resilient, but they are operating with less external cushioning than in previous decades. Recognizing and adapting to this reality is essential to maintaining stability in a system that still rests, to a significant degree, on confidence in the dollar and the institutions that support it. The effort to reinforce dollar-based energy trade is unfolding in an environment fundamentally different from the one that allowed the original petrodollar system to consolidate. The defining feature of the current landscape is not hostility in a narrow sense, but pervasive strategic competition that has reduced trust across economic, financial, and security domains. Energy producers and consumers are no longer operating within a broadly shared framework of geopolitical alignment, where dollar usage could be assumed as a neutral, efficiency-driven choice. Instead, currency decisions are increasingly interpreted through the lens of sanctions risk, political leverage, and long-term strategic autonomy. This shift complicates any attempt to stabilize or reinforce existing settlement norms because the motivations driving diversification are not purely economic and therefore cannot be addressed solely through market incentives. For major energy producers, the calculus has changed materially over the past decade. Dollar settlement once maximized liquidity, minimized transaction costs, and ensured seamless access to global financial markets. Those advantages remain real, but they are now weighed against the potential vulnerability created by concentration in a single currency system overseen by a rival sovereign. The expansion of sanctions regimes, the freezing of foreign reserves, and the politicization of payment infrastructure have altered risk perceptions at the sovereign level. Even countries that maintain cooperative relations with the United States have absorbed the lesson that financial exposure can become a strategic liability under adverse conditions. As a result, producers are seeking optionality rather than replacement, experimenting with alternative currencies, bilateral clearing arrangements, and local currency trade where feasible. These steps are cautious and incremental, but they reflect a durable shift in behavior that is difficult to reverse through persuasion alone. Energy consumers face a parallel, though distinct, set of incentives. Large importing economies are increasingly sensitive to the balance of payments implications of dollar-denominated energy purchases, particularly in an environment of higher interest rates and volatile capital flows. For countries with persistent current account deficits or limited reserve buffers, reliance on dollar settlement exposes them to funding stress when global dollar liquidity tightens. Diversifying settlement currencies or establishing offsetting trade arrangements can mitigate these pressures at the margin. At the same time, consumers are mindful of geopolitical alignment risks, especially when energy security intersects with broader strategic competition. This reinforces the appeal of payment flexibility, even when dollar settlement remains commercially efficient. Against this backdrop, traditional tools for reinforcing dollar dominance are less effective. In earlier periods, implicit or explicit pressure could be applied through access to U.S. markets, security guarantees, or diplomatic influence. While these levers still matter, their deployment now carries higher costs and greater risk of backlash. Energy producers are more willing to absorb short-term inefficiencies to reduce long-term strategic exposure, and consumers are increasingly adept at navigating fragmented financial architectures. Attempts to force compliance through coercive measures can accelerate diversification by validating the very risks that actors are seeking to hedge against. This creates a delicate balance in which overuse of power undermines its own effectiveness. The U.S. response has therefore evolved toward a more complex blend of instruments. Diplomatic engagement remains central, but it is increasingly complemented by security cooperation, investment partnerships, and efforts to enhance the attractiveness of U.S. financial markets. The objective is not simply to mandate dollar usage, but to make it the most convenient and least risky option relative to alternatives. This includes maintaining deep and liquid markets, predictable regulatory frameworks, and reliable access to clearing and settle. Immense infrastructure. However, each element of this strategy involves trade-offs. Security commitments entail fiscal and political costs. Financial openness raises concerns about domestic stability and regulatory oversight. Diplomatic concessions can provoke internal opposition or strain alliances. Domestic political constraints further complicate policy execution. The willingness to extend security guarantees, tolerate trade imbalances, or accommodate foreign investment, is shaped by domestic constituencies that may be skeptical of globalization or foreign entanglements. This limits the scope for grand bargains that could reinforce alignment around dollar-based trade. At the same time, fiscal pressures constrain the ability to offer economic incentives at scale. The result is a policy environment in which maintaining the status quo requires continuous effort, while deviation by counterparties requires only incremental steps. The risk in this setting is not sudden abandonment of the dollar in energy trade, but gradual normalization of alternatives. As more transactions occur outside the dollar framework, even if marginally, the psychological and operational barriers to diversification erode. Market participants gain experience with alternative settlement mechanisms, liquidity pools deepen modestly, and supporting infrastructure improves. Over time, this can harden into parallel systems that coexist with the dollar but reduce its centrality. Once established, these arrangements become difficult to unwind, particularly if they are reinforced by geopolitical alignment among participating states. Missteps by U.S. policymakers could accelerate this process. Heavy-handed pressure, inconsistent signaling, or abrupt policy shifts may be interpreted as confirmation that dollar dependence carries unacceptable risk. Conversely, perceived retrenchment or ambivalence could encourage actors to accelerate hedging strategies while conditions remain relatively benign. The challenge is to project reliability without rigidity and influence without coercion. This requires a nuanced understanding of counterparties, domestic constraints, and strategic objectives, as well as a willingness to accept incremental erosion in exchange for preserving core functionality. The broader implication is that the petrodollar framework is no longer a static structure that can be defended through inertia. It is a dynamic set of practices that must be continually justified in a competitive environment. Geopolitical rivalry ensures that economic decisions are scrutinized for strategic implications, and trust deficits magnify the perceived downside of concentration. In such a context, reinforcing dollar-based energy trade becomes less about asserting dominance and more about managing relative attractiveness under constraint. This erosion of certainty has consequences for financial stability. As settlement norms fragment, the predictability of dollar demand linked to energy flows diminishes. This feeds back into funding markets, reserve management, and asset allocation decisions. Policymakers must therefore operate with an awareness that actions taken for geopolitical reasons can have unintended financial spillovers, and vice versa. The margin for error is narrower because feedback loops are faster and more complex. Ultimately, the interaction between geopolitical competition and monetary architecture is reshaping the environment in which dollar-based energy trade operates. The United States retains substantial advantages in market depth, institutional credibility, and network effects. However, those advantages must now be actively maintained rather than passively assumed. Success depends on preserving sufficient alignment to keep the system functional, while avoiding actions that would entrench resistance or accelerate diversification. Failure to strike this balance risks making fragmentation self-reinforcing, as each defensive adjustment by one actor validates similar behavior by others. In such a scenario, the challenge would no longer be reinforcing an existing framework, but managing the consequences of its gradual dilution in a world less willing to rely on a single financial anchor. The prospect of a disorderly adjustment in the petrodollar system represents one of the most consequential, yet least publicly articulated, risks facing the global financial architecture at this moment. The core danger does not lie in the slow and methodical diversification of energy settlement practices, which markets can absorb over time, but in a sudden loss of confidence that compresses decision-making horizons and forces rapid, defensive shifts in behavior across sovereigns, financial institutions, and corporations simultaneously. In a system as deeply interconnected as global energy finance, confidence functions as an invisible stabilizer. When that stabilizer weakens abruptly, the resulting movements are not linear or contained. They propagate across current funding markets and asset classes with speed that overwhelms conventional policy responses. Energy markets sit at the nexus of real economic activity and financial flows. Oil and gas are not merely commodities. They are inputs into nearly every production process and a central component of trade balances for both exporters and importers. Dollar-based settlement historically provided a common unit of account that simplified pricing, hedging, and financing across this complex web. If confidence in that arrangement were to fracture suddenly, the immediate consequence would be a scramble to reassess currency exposure across energy contracts, shipping finance, inventory financing, and derivative hedges. Even participants who intend to remain within the dollar system would be forced to adjust collateral practices, margin assumptions, and liquidity buffers in response to heightened volatility. This mechanical repricing would transmit stress far beyond the energy sector itself. Currency markets would be among the first channels to reflect such stress. A rapid reassessment of settlement norms would increase demand for currency hedges, widen bid-ask spreads, and strain swap markets that intermediate between dollar and non-dollar funding. For countries heavily reliant on energy imports, abrupt shifts in invoicing or payment terms could expose unhedged currency risk at precisely the moment when global liquidity conditions tighten. Exporters, meanwhile, would face uncertainty over the future value and usability of their receipts, complicating reserve management and fiscal planning. These pressures would interact with existing vulnerabilities, amplifying volatility rather than dispersing it. Rates markets would not remain insulated. The petrodollar system has historically supported a steady recycling of surplus revenues into dollar-denominated assets, particularly U.S. Treasuries and agency securities. A disorderly adjustment would disrupt this flow not through a deliberate policy choice, but through precautionary behavior. Sovereign investors confronted with uncertainty would short duration, hold higher cash balances, or delay reinvestment decisions altogether. In an environment of already elevated issuance and constrained dealer balance sheets, even temporary hesitation can exert outsized upward pressure on yields. Higher yields, in turn, tighten global financial conditions, raising borrowing costs for governments, firms, and households worldwide. The interaction between energy pricing and interest rates would further compound instability. Energy prices are sensitive not only to physical supply and demand, but also to financial conditions, inventory financing costs, and speculative positioning. Sharp movements in rates and currencies would feed directly into commodity price volatility, complicating inflation dynamics at a time when many central banks are already navigating narrow policy corridors. Rising energy prices driven by financial stress rather than fundamentals would force policymakers into difficult trade-offs between inflation control and financial stability, reducing the clarity and effectiveness of their signals. Emerging markets would be particularly exposed in such a scenario. Many rely on dollar-denominated energy imports and carry external debt obligations linked to U.S. rates. A sudden tightening in dollar liquidity combined with energy price volatility would strain balance of payments positions and erode foreign exchange reserves. History shows that these dynamics can escalate quickly, as capital outflows accelerate in response to currency depreciation and rising risk premia. What begins as a settlement issue in energy trade can thus evolve into a broader crisis of confidence in sovereign creditworthiness, with spillovers that extend well beyond the countries initially affected. Financial institutions would also face significant operational and balance sheet challenges. Banks that provide trade finance, commodity hedging, and cross-border payment services would encounter higher counterparty risk and greater volatility in collateral values. Margin calls could rise sharply, forcing clients to liquidate positions or seek emergency funding. Non-bank financial intermediaries, which play an increasing role in commodity financing and derivatives markets, may lack the access to central bank backstops needed to absorb such shocks. The resulting liquidity mismatches could amplify stress through forced deleveraging and asset sales, reinforcing negative feedback loops. It is precisely these feedback loops that make a disorderly adjustment so dangerous. Once volatility increases across currencies, rates, and commodities simultaneously, market participants are incentivized to prioritize liquidity over return. This leads to hoarding of cash, withdrawal from risk-taking, and rapid repricing of assets. In such an environment, price discovery becomes abrupt and discontinuous, increasing the likelihood of overshow. Oating and misallocation. Policymakers find themselves reacting to market moves rather than shaping expectations, a reversal of the dynamic that underpins effective crisis management. Recognizing these risks, policymakers are focused on containment rather than reversal. The objective is not to freeze the evolution of settlement practices, which would be neither realistic nor credible, but to ensure that changes occur at a pace that markets can internalize without destabilization. This involves maintaining open channels of communication with major energy producers and consumers, reinforcing the operational reliability of dollar-based payment systems and signaling a commitment to market liquidity even amid geopolitical tension. The emphasis is on predictability, because uncertainty, rather than diversification itself, is what triggers disorderly behavior. Containment also requires careful calibration of policy actions to avoid unintended acceleration of diversification. Measures perceived as coercive or punitive risk validating the fears that motivate rapid adjustment. Conversely, clear and consistent policies that emphasize the continued functionality of dollar markets can slow the momentum of defensive shifts. This is a delicate balance, particularly in a political environment where domestic pressures may favor more confrontational stances. The cost of miscalculation, however, is high, as once confidence erodes sharply, it is difficult to restore without extraordinary intervention. The urgency surrounding this issue reflects a deeper understanding that energy pricing and currency stability are structurally intertwined. Energy trade generates some of the largest and most predictable cross-border financial flows in the global economy. These flows anchor liquidity conditions, support reserve accumulation, and influence investment patterns. Disruption at this level does not remain confined to a single market or region. It cascades through the system, affecting inflation, growth, and financial stability in ways that are difficult to disentangle after the fact. Once feedback loops accelerate, policy options narrow rapidly. Central banks may find that liquidity provision stabilizes markets only temporarily if underlying confidence in settlement norms continues to weaken. Fiscal authorities may face higher borrowing costs at precisely the moment when countercyclical support is needed. International coordination, which could mitigate some of these pressures, is harder to achieve in a fragmented geopolitical environment marked by strategic rivalry and mistrust. Each delay increases the eventual cost of stabilization, both economically and politically. A disorderly petrodollar adjustment would therefore represent not a single shock, but a regime shift in how global markets process risk. The system's capacity to absorb stress would be reduced, volatility would become more persistent, and the margin for policy error would shrink. Preventing such an outcome requires sustained attention to the mechanics of confidence, not just the symbolism of currency dominance. The focus must remain on managing expectations, preserving liquidity, and ensuring that inevitable changes occur within a framework that markets perceive as orderly and governed by clear rules. The stakes are high because the petrodollar system, while evolving, still underpins a significant share of global financial stability. Allowing its adjustment to become disorderly would magnify existing vulnerabilities at a time when fiscal strain, monetary tightening, and geopolitical fragmentation are already testing the resilience of the global economy. In this context, vigilance is not optional. It is the primary line of defense against a cascade of reactions that, once unleashed, would be costly to contain and even harder to reverse.